Edition, thank you, ladies and gents. Evening, appreciating those on the webcast. I will say up front, I'm not talking about Trump because I don't know what he'll say. So, or what mind he will change or anything like that. So we will park that as an unknown and leave it on the side. So talking offshore investing, in many senses, it's akin to local investing, right? You're buying shares, you're buying ETFs. There's some nuances. We will go into that. That's global GDP. In dollars. It's estimated for the 2024 because we don't yet have all the data coming through because not all the final numbers have been put out. And top left, right up there is South Africa at about $418 billion, which sounds quite nice. US, of course, a little bit more than us. To put that in perspective, we are smaller than Belgium. We are bigger than Colombia. We are, interestingly, bigger than Czech Republic. But we're smaller than Russia. We're half the size of Poland. In a very large world, we are about 0.46% of global GDP. And if we look at particularly our exchange, i.e. the JSE is about 0.3% of global traded equities. We are absolutely tiny. We love our country, and in some ways we box above our weight, other ways not so much, but we are a very, very small part, and hence we look to the offshore. There are about 55,000 listed stocks globally. I'm not talking sort of pink sheets and over-the-counter. These are listed on a recognized exchange that you can buy and sell across a massively wide selection of sectors. JSE's got about 400 stocks, about 300 of them are domestic, limited sectoral exposure. Important point on the JSE, if we look at the top 40, which is currently making all-time highs, or was last week. The top 40, although they are South African listed companies, somewhere around 60 to 70% of their businesses are offshore. In other words, the top 40 is not the sort of local exchange that we think it is. And that's applicable for most. You see similar numbers coming out of India, even coming out of European exchanges and the like. As an example to size, the restaurant industry in America has 54 listed stocks. It is worth $600 billion, which if we quickly go back there, our economy is $415 billion. So the listed restaurant sector, things like Young Brands, McDonald's, and the others, is bigger than our economy. And if you look at our listed JSE, we've got two stocks. Two stocks that are restaurants, Spur and Famous Brands, fairly household names. Market cap 8.5 billion ZAR, call it $500 million. It means that the restaurant sector in the US is 1,200 times bigger than the restaurant sector in South Africa, in the listed space. Now, make no mistake, I don't have kids, so I don't go to Spur, to be clear. But I mean, our restaurant, Spur and Famous Brands are perfectly good. They're great, they're profitable, they have good margins. Famous Brands very much vertically integrated. Spur has a very strong balance sheet, zero cash. They're great businesses, but we got two. Now, there's also the paradox of choice, which says less is more. That says, give me 54 restaurant stocks and I don't know where to start. Give me 2 restaurant stocks and I can do a deep dive and get to a sense and decide which one is worth getting into. So there is that paradox of choice. It's easily solved by something like an ETF, although that gets complex. We'll touch on that in a bit in time. But that just gives you a scope of size. The restaurant listed space in America is bigger than South Africa. So how do we get South Africa exposure? We've got it already. We live in South Africa. Our home is in South Africa. We work here, we save here. Our Reg 28 T's and C's is 55% invested into South Africa. We are concentrated in this market. Most of us will have a significant portion of our net worth in South Africa because we buy a house. It's whether you're buying it in Gqeberha or Atlantic Seaboard or Bryanston, it is a South African asset. So we have huge concentration already. And it's not about saying, South Africa is a horror place. As I pointed out, our market's at all-time highs, and there are other North American markets that are not quite so much at all-time highs. It's not about whether we think South Africa is a lacquer place or not. It's about whether we think there's more out there. We have significant concentration already to this economy and to the market, just by the fact that we live here. It's also the dream, which is to live in South Africa and to earn US dollars. I mean, that's got to be the ultimate. The trick is, for most of us, is finding that job that pays US dollars is not quite that easy. So what do? Well, you build a portfolio in dollars, it pays you dividends, and there's your dollar stream. It's a slower process than getting a job, but it's certainly in many ways an easier process than sort of just rushing off and saying, let's go and work for, I don't know, some other American company or someone who will give us dollars. And then the big one is the rand. Now, there's a couple of things. This is going all the way back to the mid-80s. The depreciation over that period averages at about 6% per year. Excuse me. In other words, our currency gets weaker by about 6% per year. But it is not linear. That peak in 2001, December 2001, 1361. Then later in late 2005, 575. It is not linear. Then we can see collapses. We can see the 08 crisis. We can see the 2016 crisis. We can see the pandemic. And we can see where we are at the moment. This screen grab was taken on Friday. The rand is now 18.39 when I checked a little while ago. Be that as it may, what we can see is a fairly clear trend. What we can also see is that it is a volatile currency. Problem is that our rand, in emerging market sense, so forget the developed economies, look at emerging markets, the Turkish lira, the Brazilian real, in the olden days we would have thrown the Russian ruble into there, the Indian rupee, etc. If you are an asset manager sitting in New York and you want exposure to emerging market currencies, rather than buy a basket, you just buy the ZAR. Or you trade the ZAR, long or short, depending what the exposure is that you want. So we get an overly large amount of liquidity going through our rand, which is great for us because it means we don't get crazy spreads, but it does mean we get a vast amount of volatility in our rand. This is a weekly chart, you can see for a couple of weeks it was fairly stable at around the 1820 level. The point is, we get a lot of volatility coming through our currency. And ultimately, we get that 7% a year weakness over the long term. If you'd bought in December 2013, and you can't quite see the spike, it was December 2001. It was 2015 before the rand got back to 1361. Interestingly, that's about when the Nasdaq peaked, and it was about 2013 when the Nasdaq got back above its all-time highs. That itself is a different story. But careful of the sense that the rand is a one-way bet. It is a one-way bet over your lifetime. But in the short and even the medium term, that is not necessarily the case. And that is hugely important. And I'm going to come back to it in more detail. But it's hugely important that in the shorter term, and sometimes that short term might be 5 years or more, in the short term, the rand might not be a one-way bet. And there's a lot out there that says our rand could potentially head down into the 17s, 15s. Some folks are even saying 12. And we can see the massive rally post the pandemic down to 14 rand. That was on a commodity boom. If commodities start running, all of them, if iron ore, coal, PGMs, nickel, zinc, copper, and gold, which of course is already running, if we start to see all commodities running, our rand will strengthen. That's what's happened post-December 2001, was that massive commodity rally which sees the rand strengthen. And the reason's quite simple, because gold miners and PGM miners and coal miners, they get paid dollars for their commodity, and then they turn it into rands. And if you remember in 2021, the finance minister had a surplus of 150 million in excess of tax receipts. That was simply dividends and corporate tax coming from the commodities. We are ultimately still a commodity economy. So if China suddenly started absolutely flying again and demanding commodities, our market would rally like crazy and our rand would easily be $12. And I know everyone thinks that's crazy, but if we take it to the 2001 collapse, our rand could technically go sub 10. I'm not suggesting it will. But understand that our rand can, in the short term, and that short term can be years, that rand can do totally crazy things. So how much offshore? We need to match our needs. I mean, if you are currently, you've got a pile of cash and you are living off it, then zero. Because what happens if the rand goes to 9 and suddenly your income effectively halves because of currency strength? If you don't need the money, if you've got a 10-year view, well, then you could shift it all offshore. I mean, there's that blend there. Now, you're not going to get to shift it all offshore because you've probably got a Reg 28 product to which 45% is allowed offshore, and most of the fund managers are sitting at about 38%, and some of them are reshoring money back in. So it's somewhere between that 0 and 100, and it's up to the individual, and there's many ways we can do it, and I'll come to that in a lot more detail. But you need to decide how much is it, and it's not a case of, well, look at that rand chart, let me just take it all offshore. Tomorrow morning, wake up and just ship the whole lot. Because if the rand does go to 12, then you look silly. Now, if the rand goes to 30, then you look like a genius. But it's about managing risk. And don't fall into the trap that, way smart people have told us that the rand would be 20 to the dollar by 2025. And well, here we are, 60 to the dollar by 2025, and here we are, and we're not yet quite touching 20. We won't name names, but you can go and Google it. It was a very, very scary headline in 2016. So how much? I mean, truthfully, probably more than you've got right now in most cases, whether direct or indirect. Should it be 100%? Probably not, because if you get to retirement and the rand's on a tear and there's a commodity boom, you're going to look silly when your investment in ZAR, which is where you spend, is starting to collapse. Remember, we spend in rands. That's what matters. We're spending in rands, so we need those rands to spend them. In an ideal world, you probably want 5 years of ZAR spending in ZAR. That might be covered by your salary. If it's not being covered by your salary and it's being covered by your investment, 5 years is probably the safety net. And even at times that might not quite be enough, but statistically it probably catches it. So I stay with the majors. I buy dollars, a bit of euros, I'll buy sterling as I need. And I'll tell you in a moment why sometimes I need sterling. I'm not interested in yen. I have no interest in Aussie dollar. I have less interest in Swiss franc. Swiss franc is supposedly a major currency, but they pegged it for a while and then they lifted the peg and brokerages went bankrupt as a result. To me, it's a dollar-euro world. Is the death of the dollar imminent? No. For as long as I've been in the market, the death of the dollar has been talked about. Certainly the global influence of the dollar has waned. Certainly under President Trump that may continue further, but the dollar is not disappearing overnight. And then the second global currency ultimately is euro. As I said, sterling as needed. Exchanges depends on offering. What do you want to buy and where is it available? I typically stick with New York, London, Frankfurt. Everything I've ever looked for has been in one of those three. And if it's not on one of those three, then I start to wonder that I'm going down rabbit holes I'm best getting out of. If you find some stock and it's listed in some exchange you've never heard of in some country that you couldn't identify on a map, you're probably not, just walk away. There's no need for that. So I'm focusing primarily on those three. Mostly it's New York, London because of circumstance, and then Frankfurt a bit. But most of mine is dollar, it's New York, it's nice, it's simple. Quick point on the euro chart. Euro chart would look vaguely similar to the ZAR. Dollar, ZAR, euro is going to look more or less the same. There is a slight disconnect between the two, and that's down to liquidity. In other words, if the dollar-euro was 1-to-1, we wouldn't see our rand, euro, rand, ZAR being exactly the same because of liquidity. So when do you offshore? The short answer is don't try and be an FX trader. As soon as someone needs to move money, suddenly they're an FX trader and they're going to get the absolutely perfect timing right, and probably not. What I typically do is I've got a process. I move money on a regular basis. I'm just somewhere moving money. When it strengthens markedly, I will try and find more money to try and shift extra when I've got that opportunity so I get more bang for buck. If the rand is suddenly 15.50 next month, I'm going to be, telling my cat it's time to pay rent because I need ZAR because I want to buy dollars. So let's not try and get overly clever of it. We can have a process. I've bought rand at some really, really bad times, but every transaction except for one is pretty much in profit. And the one that isn't happens to have been February 2 years ago. We got grey listed. The rand went to 1950, if memory. I was on holiday in Cape Town, and I was just so offended by our government getting us grey listed that I bought some dollars at 1950. That's my worst level. Does it stress me? No. I was going to say I'm young and patient. I'm neither of those anymore. But you know what? The rand will be above 1950 in my lifetime again. I remember one of the collapses, and I forget when it was, and I bought rand, and it was absolutely horrible. It went stronger for years, and I think I paid $12. And at the time, it stressed me. I mean, Hugh here wouldn't like to get $12. Don't stress it. We can spend far too much time trying to be an FX trader. Most FX traders lose money. Let's not get involved in that. It's about the dollar cost or rand cost averaging. It's about just doing it as a process. So the question is, how do we do it? How do we get our money offshore? These days, it is markedly easier than it used to be. Let me just check that. I'm getting told my mic is not great. There we go. It used to be hard. I mean, those of you who are very old will remember traveling in the 80s and 90s when they would stamp the back of your passport with how much money you had taken. You used to have to get Thomas Cook traveler's checks. They were a legit thing. There were onerous exchange controls. These days, not so much. We have a lot more ease towards how much we can move and how we can do it. And certainly prices have come down. Again, even just 10 years ago, moving currency was hugely expensive. So that was me asking Dali, someone swimming, someone getting across an ocean. And that's the picture we get. We don't. So there's lots of ways, and some of them are simple, dual listed. You can buy Richemont in rands in South Africa. Now you could also buy it in Switzerland, and it's the same company. The difference being is that here it's nice and easy. And if the rand weakens against the Swiss franc, we will benefit locally. If the Richemont price goes up in Switzerland, it'll benefit locally. Same with British American Tobacco, Anheuser-Busch. There are loads of what we call dual listed. In other words, companies that are listed in South Africa but are also listed somewhere else. The question is, where is the price determined? The price is determined where there's more volume happening. So with British American Tobacco, most of the volume's happening on the FTSE. Anheuser-Busch, most of it's happening in New York. Richemont, most of it is happening in Switzerland. So we kind of follow. Now, we don't completely follow because, of course, there's not always overlap of hours. Depending, the US we're closed, Anheuser-Busch is still trading in America. But we can buy, and let's use British American Tobacco as an example. They pay quarterly dividends. They report in sterling. They pay dividends in sterling, and they then convert that into rands if you are owning it on the rand register. So you've effectively got an offshore investment. It just happens to be sitting on the JSE. And when I talk around some 75% of our top 40 being ex-SA, that's an example of it. Process is another. Process owns assets in Europe, tech assets. It owns Tencent, of course, in China. It reports in euros, but it's listed in South Africa, and we can access it in South Africa. Then we get local stocks earning dollars or euros. Some of them small, like Master Drilling. They make holes for miners. It's a lot more fancy than that, but essentially they do. And they report and earn in dollars. Now, in the case of Master Drilling, they're in about 28 different countries, so they've got a lot of moving parts there. But someone like Nepi Rockcastle, who owns property in Eastern Europe, they earn euros, they report in euros, they pay a euro dividend, and then they convert it into ZAR. And our share price will be moving on both the sentiment of the stock and the currency at the same time. Others like Quarter, which spun out of Old Mutual. There are a bunch of companies which are either dual listed or in some cases are just earning foreign currency. And therefore we're effectively getting offshore with it. Locally listed miners. All of our miners sell their commodities in dollars. All commodities are priced in dollar. So the gold miners, obviously having a heyday right now. Gold at what, 31.50 as we speak. But if the rand suddenly went to 30, those gold miners would go further through the roof because their revenue, which is dollar-based, when converted back to rands, would absolutely explode. There's T's and C's here. Some of our gold miners have got assets all over the world, and then there might be other challenges and inflationary issues, etc. But it's an easy way, again, to get offshore exposure. And it's not pure, but it is real in that sense. Then we've got listed offshore ETFs and ETNs. I'm not going to go into details around what ETFs are, except to say they are a basket of shares. And our February Power Hour, we did a presentation on ETFs and tax-free. JustOneLap.com/Power Hour, you will find all of that. So we can go and buy an ETF in rands on the JSE that tracks the S&P 500. And that ETF issuer takes your rands, converts it into dollars, and buys you those 500 shares. So you've effectively got two movers of your portfolio. One is the 500 shares, the S&P 500, and the second is the currency. Which is why sometimes you wake up on a Monday and there's a bit of a jump in your ETF, because not only was the market moving Friday evening, but perhaps there was big moves in the currency sort of late Friday, early Monday, because the rand the currency is a 24/5 transaction. It's not quite 24/7. We can get NASDAQ, we can get Europe, we can get Japan, we can get India, we can get the UK, we can get offshore tech. The range of ETFs that are tracking offshore, but in ZAR, is huge. And they're a great place to put into a tax-free account. Nice, simple, you put them into your tax-free account, you get that exposure. We've also got ETNs that are issued by FNB. They trade on the JSE. They cover stocks such as Disney, such as Berkshire Hathaway, such as Nvidia, ASML, they listed just last week, Palantir, Amazon, etc. A whole bunch of well-known companies. I think there's now about 50 of them. Sorry? Not last time I checked. Although that list occasionally updates and I don't see it update. But they've got it's about 50. Do be careful. There are two flavors. The one flavor includes the currency, the other flavor excludes the currency. So you can effectively, if you want, hedge the currency out. That for me is getting too clever, so I just buy the one with the currency exposure. They're Quanto and Compo. And I can't for the life of me remember which is which. Go to justonelap.com, search Quanto. I'll explain it there and tell you which one is currency neutral, which one is not. But here we're buying direct stocks. The trick with the ETNs is they have an expiry date, either 5 or 10 years, which means in 5 or 10 years either they will roll into a new issue of it, or they will close down and you'll get your money back. You don't get dividends. Dividends go into the net asset value of the ETN. So that's a really simple way to get exposure as well. Then there are ETNs from ABSA called New Wave ETNs on the dollar, the euro, and sterling. New USD, new EUR, and new GBP. And those track the rand. So if the rand is currently 18, let's say 40 for ease, you buy it today, it goes to 20, your ETN will go from 18.40 to 20. It gives you rand exposure. And then there's futures and stuff, but I'm not going to worry about those. I'm going to park those entirely. But these are all in your JSE account. No fancy stuff required. No discretionary allowances. No offshore brokerages. Nice and simple. You get exposure to offshore in rands via the JSE. And we've had this since around, I think it was 2008, we got our first tranche from Deutsche Bank of offshore ETFs listed, the ones that Signia ended up owning, US, Japan, UK, Europe, and world. Then you want to move money physically offshore. You've got two allowances. You've got your million, which is no questions asked, nice and simple. Every individual in South Africa can take $1 million off. Very important, it is per calendar year. It's not tax year, it's per calendar year. So your single discretionary allowance is $1 million. Now that is supposed to include when you go on holiday overseas and you spend money in Australia or Europe. The reason the $1 million is there is so that every time you want to travel or buy a book from Amazon or a Kindle or something, you don't have to go get approval from the Reserve Bank. So I said, you know what, we'll give everyone R1 million. the truth of the matter is that SARB doesn't really track it, so you can take $1 million offshore and go on holiday and buy a Kindle, and that's fine. Now, to be clear, if you there's a point at which SARS is going to start opening their eyes, but as long as you're not abusing the process, every South African can take $1 million offshore. That's no stress whatsoever. If $1 million isn't enough for you, you get the foreign investment allowance. Basically, you get hold of SARS. If your tax affairs are in order, they will let you take another 10 million per calendar year. And then if 11 million rand isn't enough, go have a cup of tea with SARS and they'll see what they can do. I mean, the short answer is the exchange controls are there, they exist. They are not a limit to anyone except maybe Patrice Motsepe and, the Rupert family and a few others, Mutons, etc. For most of us, the $1 million is fine, the next 10 is plenty. We don't need to go and have tea with SARS. And we can take it off. And that first $1 million, as I say, is self-reporting, so nice and simple. If you're looking for the foreign investment allowance, your accountant can do it. In some cases, your stockbroker can do it as well. Offshore brokers. There are... I tried to find out how many offshore brokers there were. I asked some fancy large language models. They came back with various different numbers. I suspect there are more offshore brokers than there are offshore stocks. There are 55,000 shares. There's probably more than 55,000 offshore brokers. I am not going to talk to all of them. If you are wanting to go onto an offshore broker, do your diligence. Now, some of them won't take South Africans because we're on the grey list. Some of them won't take South Africans because they just don't want people beyond their geography. But I get all the time someone has found some broker and I want to use this one. I mean, the one chap found a broker. It's registered in Cyprus. They only accept Bitcoin as deposit, and he wants to use this. I'm like, I can't help you. Like, really, I can't help. I mean, there are more red flags in there than there are sharks in the Mediterranean. So, if you're going to go do it, find a big name, make sure they're legit, check with the registered authorities, go and check reviews, etc., etc., etc. Make sure that they are, because there are a lot of less than legit brokers potentially out there. So Standard Bank's got the Web Trader, which is a full service offering. It is multiple exchanges. It includes Australia. It's a whole bunch across Europe, North America, including Toronto. The whole full service, multiple different currencies. You can also get single commodities, you can get CFDs. It is a full service offering. It is practically also offshore. You make your deposits into I think it's a Deutsche Bank account in New York. It is the legit process. The benefit is that your support is sitting here in Johannesburg, and if you don't like it, you can come to this building and knock on the door and say, please sir, can I have my money? Whereas if it's in Cyprus and it's Bitcoin and Russians, maybe not so much. So that's Standard Bank Web Trader. It is the full offering. And again, it is the real McCoy. And then Shift, which is relatively new, came along about, I think, 8 years ago. So Shift started life, it's an app. It started life as a way to buy foreign currency. Then it expanded. It started offering you virtual and real world credit cards, so you can do online transactions. So if I'm buying something in dollars, I don't use my credit card to buy it in dollars. I use my Shift virtual card to buy it in dollars, so I don't get ripped on exchange fees and offshore transaction and all of those type of things which you will see coming through on your account. It is not a full offering. It has 3 exchanges, New York, London, Frankfurt. Most recently also added the JSC. We'll park that aside. So New York, London, and Frankfurt are your 3 exchanges that you can access. And it has 4 currencies. Obviously there's ZAR in there. It's got Euro, Dollar, Pound, and Aussie Dollar are your 4 currencies. And within the world of New York, for example, they don't have all 10,000 shares and ETFs from New York. If there is one that you want to be added, poke them, say Simon says, and they can add it for you. It is just simply a process. Edition, who snuck out, who introduced us, just goes into the back office and adds it. Easy enough. In time will we get the full offering? I don't know. But for now, I have once found a an ETF that was listed that wasn't available. It was the luxury ETF, luxury market ETF, and they added it for me, no problem. And then I didn't buy it because I owned Richmond, so I felt a bit silly. But anyway, sorry, Adishan, but he left. Two easy ways. Key point with Shift, you don't need to necessarily be transacting within Shift. In terms of ease, but more importantly perhaps in terms of cost of transaction and spread on the currency, Shift is quantifiably the cheapest. And I don't say that because I'm standing here in their building. I say that because I've gone and dug the numbers. Because there's a couple of ways where you get charged fees when you're buying currency. The first is the spread. So I just said the rand's 1840, and if you go to one of the money dealers out here in Rosebank Mall, yeah, they will sell you rands, but they're going to sell you at 1950 and they'll buy them at 1710. That's the spread, and that difference is their profit. Now, truthfully, the money dealers out there are cagey. The banks are, the other institutions, they are narrower, but you'll often find them exceedingly wide. Typically, and I'm watching a live FX price, when I'm transacting on Shift, I'm a couple of cents, maybe 5 cents either side. And then there's no other fees. Some institutions will have their spread, and then they've got other fees. There's a transaction fee, there's a this fee, etc., etc. It's small cents, but like I was say, if there's money to be left on the table, it goes into my pocket rather than somewhere else. And then once you've got your money in Shift, you can transfer it to one of, if you've got a broker you like, I don't know, you've got a friendly broker in London or you, wherever the case is, you can then use that for international payments and then pay that into your brokerage account, wherever that might be in the world. So now you've got your money offshore. You've looked at the JSE story and you thought, yeah, you've got yourself some Richmond, you've got some S&P 500 and all of the other ETFs here, you've got nice exposure, but now you've physically got ZAR offshore. What's next? Well, in the one sense, there's no mad rush. Your money's offshore. You're going to be earning over the long term about 7% a year. It's not quite inflation, well, it's probably inflation beating, but not by a heck of a lot. But there's no mad rush to necessarily do anything. It's not a case of move it today, spend it tomorrow. You can move it today and spend it tomorrow. You can give yourself a little more pause if you want. So what have we got? First thing we got obviously is ETFs. And be prepared to be overwhelmed. The first time I opened WebTrader, 20+ thousand shares, and it was just too much. So I thought, no, I'm going to narrow the search. All I want to see is ETFs. So I said, show me ETFs. Yeah, 1,200 and change. I just shut it down. Like, where do you start with 1,200 ETFs? There is a humongous range. And if you look at something as simple as just the S&P 500, we've got 1, 2, 3, 4, I think 5 S&P 500 ETFs on our market. You go offshore, on the US, there's probably 20. The famous is the VOO, the Vanguard, because its total expense ratio is 0.03%. So they are cheap. Our cheapest ETF, which is top 40 from Satrix, is 0.1. Most of our ETFs are on the 0.3 to 0.6 range. They've got 0.3. So almost free. I mean, that's practically a rounding error. So if you want to invest thematically, and what I mean by thematically, you decide that you want to invest into emerging markets. Maybe you want to invest into power utilities. Maybe you want to invest into nuclear. Maybe it's big tech. Maybe it's frontier markets. If you want to invest thematically, you will find, in most cases, an ETF available for you listed in New York. To the point that, there are ones on lithium and battery tech. There is a social media one. There is an absolute crazy range. Be very careful about sort of getting too FOMO for the niches. When I did a deep dive on the luxury ETF, it's nice, but there's different types of luxury. And I really want that top end, which to me is Race, which is Ferrari, and Richmond. LVMH is lacquer, but part of that is whiskey, and I appreciate there's expensive whiskey, but to me that's not the level of luxury that I was looking for. So I'm going fairly concentrated in that space. The social media one, you would think, okay, so it's social media, so it's like Reddit and Meta and Pinterest, and it would have been Twitter back in the day, but it's not. It's a whole bunch else as well. So if you're looking at various offshore ETFs, read the small print. Read what they actually got in them. What is their methodology? And have a look at their top holdings. You don't have to go through all of the stocks, but at least their top 10 holdings. Does this to you look like what it says on the sticker? And oftentimes it just doesn't. I, for example, was looking for a water ETF. Okay, water. I mean, not just because we live in Johannesburg, and what do they say? Water, power, Wi-Fi, you can have two. We once woke up on a Sunday morning and had 0. That's another story. I wanted a water ETF. I think water's big. Water, we need it to cool the data centers. We need it to drink. Much parts of our planet are water scarce, etc., etc. So I found a couple of water ETFs, but when I dug into them, it was basically just utilities. And truthfully, Joburg Water, what do they call them? City Water, whatever they call themselves, is no better or worse than Thames Water or many of the ones in the US. They all have the same problem. Infrastructure that is 50 to 100 years old, and they've underspent on maintenance. So this ETF, one of the big holdings was Thames Water. All I know about Thames Water is 2 things. There is surge in the water, and it might go bankrupt. I'm like, I can get that in Joburg. Like, yeah. So make sure, because it says water, and you think it's water, and it is water, but what is it? I want new water. I want technology for cleaning water. I want that sort of no, I don't want Thames Water. So dig into those ETFs, and when in doubt, back out. Remember this, which I spoke about that image there from the ETF presentation we did last month. At the very bottom, your sort of base ETFs. Those would be wide, global, diverse. In S&P 500, I particularly like global/VT. I'll go into that in a little more detail. That should be somewhere between 50 and 100% of your portfolio is those base ETFs, either in ZAR, dollar, euro, whatever the case. Then you can have some thematic above it. Maybe you want water, maybe maybe nuclear, whatever the case may be. You can go and find those thematics, and then right at the top, if you want to, you can go and do stocks. For everyone out there, we must have a lot of base ETFs. As you move up that pyramid, your risks increase because you're narrowing it down thematic. Instead of just saying the world will be bigger in 10 years, you're saying that will be bigger, tech stocks or water stocks or whatever the case may be. And then as soon as you go to individual stocks, well, you run the risk of Steinhoff. No, we don't have many Steinhoffs in our history, but to be clear, we have a couple of them splattered around, so that just increases the risk. So more at the bottom, less at the top. Nothing wrong with having everything at the bottom and nothing at the top. So for me, I keep it very simple. Mostly because I like simple. Simple always works for me. I have some individual stocks. I have Johnson & Johnson for a 3% dividend yield. And if it goes back to 140, which I think it might do, you're suddenly on a 4% dividend yield in dollars, fairly consistent. Do they have problems where occasionally they get sued? Yes. And weirdly, that doesn't seem to be a problem. I mean, I don't understand the math either, but that doesn't seem to worry the market overly. They've got that talcum powder one at the moment. They've provisioned for it. The judge keeps on saying he wants more money. The market seems unfazed. Johnson & Johnson about as boring as it can get, but I like that dividend yield. And if you buy it at the right time, that div can be plus 4% in US dollars. I hold some CrowdStrike because I think cybersecurity is a big story, and I think only going to get bigger. More and more goes online, more and more needs to be protected. I like ASML because that's my way of getting exposure to AI. ASML makes the lithograph, the ultraviolet lithograph machines that makes the very fancy chips that then Taiwan Semiconductor Manufacturing Company then puts into an NVIDIA chip. So what I'm doing is finding the supply chain, and I'm going right down to the beginning. It's like, remember in the gold rush, the people who made money? Some were gold miners. Most of them sold spades or Levi's or lunch, because gold mining was hard and risky. So I'm going down the supply chain. I have some NVIDIA, but most of my AI story is in ASML. And old-fashioned, I like weakness in shares. I get them at a better price. ASML, I think, was 1,200, then it was 700. I liked it at 1,200. At 700, I buy a lot more because I like it a lot more. It's the same business, it's just a little bit cheaper. My favorite ETF is the Vanguard Total World Stock Index Fund ETF. These things do not have small names. It is exactly the same as the global ETF from the JSE. Initially issued by Core Shares, now owned by 10X Investments. It is exactly the same. In fact, the global on the JSE buys that ETF and wraps it and sells it to you. Trick is you can't get the Vanguard Total World Stock Index Fund ETF in your tax-free account, but you can get the global ETF. So I own bits of both. Why that one? So if we look at an S&P 500, people are like, oh, that's America. Yeah, but I mean, the biggest stock, or the second biggest stock, is Apple. Any of you sitting here with an iPhone, well, you didn't buy it in dollars in America. You bought it in ZAR in South Africa, yet it's an American company. The S&P 500 is largely globalized, much like our own top 40 is. The exact numbers, it's probably about 60% America and then 40% rest of the world. That number changes. It's been as low as 50. It's been into the high 60s. I haven't looked at it in recent times. A lot of it's America, but they're global companies. It's McDonald's, it's Coca-Cola, it's Visa, it's MasterCard, it's Apple, and so Microsoft, and so that list goes on. The trick with the global is that instead of just being 500 companies listed in the US, it is a little over 9,000 companies. It also includes a fair bit, it's about 11% what we would classify as small cap. It has some emerging market, no Africa, but it does have some emerging market as well. And there's sort of, how do you classify South Korea? Is that an emerging market? Is it not? It gives you a much wider range down at the tail. So it still has pretty much the 500 stocks from the S&P, and that probably makes up 80% of the ETF. But then it has that tail of 20%. All of these global ETFs right now are overweight America because America's had a couple of spectacular years in the stock market. Is that risky? You know what? These things shake out. ETFs are self-cleaning. If America has a tough decade, that's fine. Money will go somewhere else, and that part of the ETFs will increase, and it kind of offsets itself. The code offshore in New York is VT. The code onshore in South Africa is global. If you're looking for S&P 500, VOO. If you're looking for NASDAQ, QQQM. You all know the QQQ, but that charges a total expense ratio of 0.2. The QQQM is exactly the same company, everything exactly the same, but expense ratio is 0.15. Why? Well, because they had this giant ETF with trillions of dollars, and if they dropped their expense ratio from 0.2 to 0.15, they would lose tens of millions of dollars. But there's a price wall, so they start a cheap one, and a lot of people don't shift, so they keep on making money. It's the same NASDAQ 100, same stocks, tech-focused, etc. That is broadly my ETF exposure offshore. I'll show you the T's and C's in a moment. But it's simple, it's global. I haven't gone with any thematics. The thematics that I largely want, I can get out of South Africa. I largely stay away from thematic, unless individual stocks, which are usually thematic, and then, maybe some mining or something like that. But otherwise, broadly, I stay away. But anything you're looking for, you will find it. Google is your friend. I started putting together a list. I got to 4 pages and realized I was going to run out of time. Crypto, sure. You can buy crypto. There are crypto, Bitcoin and Ethereum ETFs listed in New York as well. By now, most people, if they want crypto in their portfolio, probably have it. Again, it's dollar-based, so it's offshore. And then tax. 2 things. You will pay tax. Second thing, SARS is going to tax you on your worldwide revenue. End of story. You can avoid SARS taxing on your worldwide revenue. You need to exit the country. You need to deregister as a taxpayer. It is a process. It can be expensive. You certainly can. Of course, then some other country is going to say, hey, look at there, a non-tax-paying human being, and they will tax you. You're going to pay tax. Your question is where. I just find it easier to pay tax here. If you want to get really fancy, go speak to an expert. There are a couple of things. We have something called Situs tax. So Situs tax is literally, some countries will say, you know what, we don't care where you're based, we don't care what your tax person says, we want a slice of those profits as well, please sir, thank you very much. It's mostly over, so it's residence agnostic. So it's mostly going to be things such as real estate, cash, listed shares, art, that sort of stuff. What that basically means, if you've got an asset in America and you make money, IRS says, cool, 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 I want some of that money. And then SARS back home says, cool, 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 I also want some of that money. And effectively you get double taxed. What we have, in most cases, is double tax agreements where that process is removed, so you're not necessarily, but we'll go into some details of it. Most developed economies have a form of situs. South Africa has tax agreements with most. It also does mean, because there's an estate duty issue, in an ideal world, if you've got assets in other markets, you should have a will for each market, because different countries have different processes. For example, and I forget what the law is, but your French will is fundamentally different to a South African will, just because of estate law in France. I will say off the record that I know of no one who's had to pay estate duty in the US. If you don't have a second will, your South African will can be used, but in many cases the courts in the different territories practically want a copy of the will, which means first your South African estate gets wound up, then the will gets shipped somewhere else and it gets wound up there. If you have such complexities that you have properties and vast amount of money in far-flung areas, you need a serious tax expert. I am not that person. For the majority of us, I mean, we might have more than 60,000, we might even have more than 325. Most often, they don't care. I've never heard of, I've spoken to a couple of estate professionals who handle offshore estates, and they're like, they just don't care. You know, if you're a billionaire, then they might want to take an interest, but if you're a billionaire, you've done your affairs in order. So we have the double tax agreements. And what that means is that as much as the IRS says we want your money and SARS says we want your money, the IRS and SARS agree not to double tax you. So, for example, in America, the dividend tax is 30%, but they will rebate you 15%, so you effectively only pay 15%. And the reason why it's 15 is because we haven't updated. Our dividend withholding tax used to be 15. When we moved it to 20, we haven't updated our double tax agreement with the US. But if you tell the country that you are actually not resident and that you're resident of a country with a dual tax agreement, sometimes called a double tax agreement, then you will be exempt. There's two ways you do that. You fill in a W-8-BEN form and you submit it to them. So you go to your broker in America or the Europe or wherever it is, and you fill in a W-8-BEN, and what that says to the IRS is that this person is resident in South Africa, we have an agreement with them, so only take 15%, not 30% of dividends. You can't avoid the 15. You can't avoid tax, is the short answer. We can manage it. Excuse me. If you don't want to fill in a W-8-BEN, you can go to a company such as globetax.com, and they will do the process for you. I couldn't find up-to-date pricing, well, I couldn't find pricing on their website. They used to charge $50 for 3 years. Your question is, if you pay them the $50, do they earn you more than 50? If they're going to save you $100 in tax, it's worth paying the 50. And then they manage everything on your behalf. And basically it's a notice on the registrar where the shares are that this person is not American, they are South African, we've got a DTA, please only take 15% dividend withholding tax. Then you can buy Irish, because Irish has something called the Undertaking for Collective Investments in Transferable Securities. Yeah, is about right. Otherwise known as USITS, and USITS, because it's Ireland, and because Ireland doesn't much like tax, they don't charge you any tax on your dividends whatsoever. So if you see an ETF with UCITS in the name, it is Irish domiciled, and there will be no tax on it. Of course, it will then, SARS will say, ho, 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 you didn't pay tax on that dividend. Well, looky, looky, we would like a slice. You're not avoiding it. You can maybe minimize it. there are things where you can be more efficient. So, for example, I mentioned the global ETF. It's global on the JSE. It's called VT when it's in America, but you can then get the UCITS one, and the code is VWRL. Couple of things. There's a slight difference to it. Firstly, it's listed in London. Remember earlier I said I'll buy sterling on a need-to-need basis. So it's listed in London, so I need sterling to buy it. But now, man, I'm getting currency movements all over the place, because most of the stocks in that ETF are American, so I'm taking rands, I'm buying sterling, they're buying dollar. Yo, it's getting complex. Also, the other small niches, they don't have small caps in there. Now, small caps is probably only about 8 or so % of the index. But that one, and the code is VWRL, no small caps. So yes, you might save some pennies here and there, but it washes through. There is a Vanguard S&P 500, again, UCITS. Instead of being VOO, code is USD. There's a Invesco Nasdaq 100 UCITS. Instead of the code being QQQM, it is EQQQ. We want to be careful here that we can get sort of too clever. If we're trying too hard to save a couple of pennies here and there on the tax thing. Ultimately, we are going to be taxed. We might, in some cases, pay tax in America. We might pay it over to SARS. Truthfully, I'd rather fund our infrastructure rather than their infrastructure, but that's whatever the case may be. There are a lot of the UCITS. And I remember in the olden days, and no longer so much applicable, there used to be a broker in Ireland, and you could go register with them, and it was very nice and everything, and then people suddenly decided to, because the benefit there is you just go, it's one currency, but then what everyone discovered was, yeah, SARS still wants their money. And that's the key point. SARS wants their money. And here's perhaps the trick part. So when you make a profit, you've got capital gains tax to pay. Whether you made that profit in South Africa, or you made it in Ireland, or you made it in Cyprus out of Bitcoin, whatever the case is, SARS doesn't care how you made the profit. Fun fact, if you make money from the proceeds of a crime, you're supposed to declare it to your tax agency. They don't care. You're a criminal. That's how you make money. Cool, you want tax. Oh, and you should go to jail, but first pay your tax. I don't know if that's true in this country, but certainly in the IRS tax form, one of the questions is any proceeds of crime. Tell us how much. I think what they're actually just doing is finding the dumb criminals, right? Oh yeah, tick, I was selling heroin, I made $500, knock, knock, oh, fell for that. The challenge, the problem, and it comes back to when I spoke about the zero to how much money offshore, is that all of this money is offshore. So you bought, I don't know, something, and it went up in price, and you sold it, and you made a whole lot of dollars, and that's excellent, and you declared it to SARS, and SARS said, brilliant, please send us money. And you're like, oh, hold on, but it's in dollars, and now you want SAR. Remember when I said if you've got SAR expenses, you need to be able to manage them here. So if you make a fortune in your offshore account, SARS is going to want their cut, and they're not going to, you can't say to SARS, can you wait, please, I just need the rand to get to a nice level. SARS is like, I want the money, please send ASAP. So you need, and again, for most of us, the values of our offshore portfolios aren't that significant. We're not talking tens of millions of dollars, and SARS wants a check for $500,000 or something like that. And if that is you, then get a fancy accountant, because they are worth their weight in gold. But ultimately, SARS wants your profits worldwide. They're happy that if you've got DTAs or certain markets, they're happy that we pay 15% in the US. They then want their little bit here as well, but ultimately they want it in rands, in South Africa, and they want their money. So then eventually you're going to want to return some money, because now you've been investing offshore and everything's going lacquer, and you think to yourself, I want some of those monies back into ZARs, please, so I can have some fun. I can go to, I don't know, Opi or something, whatever the case is, go dinner out or something with wine, because like we fancy these days. And then you bring the money back, and that's quite easy, something like Shift. You have to, of course, FICA your local account, and you say, please deposit it into the local bank account, and as soon as it arrives, you're going to get an email from your bank saying, you're bringing foreign currency, we need to know the source of that money. and there's 100 different codes. 515 subcode 0, disinvestment by residential individual shares. You've sold shares, you're bringing the money home. I have used various random codes. I got paid for a speaking engagement. It's weird, the company's in Joburg, the event is in Joburg, and they paid me in dollars. I'm like, odd, and my bank is like, stop right there. There is nothing that says speaking engagement. Worse, there's nothing that said, actually I worked here and earned money. So I just picked a code. Again, you know, we're not doing billions, we're not doing high crime, but best I can find 515 subcode 01. It's a balance of payment code that you need to enter. And then your money clears. Bang. I think they give you 72 hours. You punch in the code, done, dusted, nice and simple. The short answer is keep it simple. We can make this as complicated as we want with anything, but particularly with investing, particularly when you're starting to go offshore. I mean, for example, use local offshore ETFs. Have you maxed out your tax-free account? You know, you might want to offshore your money. You might want to say, I want to be 100% offshore. Well, then go and buy the S&P 500 ZAR-based ETF in your tax-free account and get some tax-free benefit. We just spent 15 minutes talking around how SARS wants your money. Here's one space where they say, oh no, but there we don't want your money. So maximize it. 36,000 a year, tax year, not calendar year, 500,000 lifetime. As I said, we did the Power Hour last year. Get some offshore ETFs, the VWRL. Truthfully, I have some VWRL. Mostly I have the VT and I have global. I'm that idea of one ETF to rule them all. Partly because once upon a time I probably owned all the ETFs on the JSE. Not all of them, but every one individually. I'd have a bit of the. Every time a new one came out, I was like a kid at the Christmas party. I'll have that one. Oh, look at that. Whoa! Yeah. And then I finally consolidated it down. I buy global, I buy VT, I have some VWRL. More than anything, I'm just trying to see how that process works, to see how it actually goes. And don't stress the rand, don't stress the tax. There's a lot we can stress here. It's not worth it. We're going to pay tax. We can be a little craftier about it. If you are getting dividends and you're paying 30% in the US and you could be paying 15, and that extra 15% is worth more than $50 a year, then go have a look at Globe Tax. And there are others out there. I just know Globe Tax. And use that as a service. If they're going to save you $100 and charge you $50, you're ahead, and that $100 will grow over time. Particularly because I like to have some nice dividend ones, such as Johnson & Johnson. And you know, whoops, wrong button. At some point on tax, none of us are the tax experts. Maybe one or two of you are. Find an accountant who can help. And if the accountant is I don't know, then maybe find a different accountant. Because as I said, you need an accountant who can help. And that was my Dali E3. Asked him for a picture of a content cat. That's me for today. Next Power Hours. We're not here April or the holidays. Anyway, it's been a tough 3 months this year. I need a lie down, so we'll come back in May, 15th of May. We did derivatives last year as a side hustle. Sorry, we did trading. We're going into derivatives, so we're focusing on CFDs, warrants, futures, and the like. And then the rest of the dates, we are monthly. We're not every third Thursday as we like because of venue availability, so we shift around the dates, but they'll either be here or at the room we got kicked out of a little while ago because of tech challenges. JustOneLab.com's events for more, and the videos all get uploaded a couple hours after the event /Power Hour. Their contact details for myself, for Shift, for Standard Online Share Trading, which also runs the Web Trader, and there are disclaimers. I have some minutes if there are questions. Yeah, so accounting on total return ETFs are difficult. So on the JSE, which is not your question, but I'll get to it, on the JSE we've largely done away with that because in collective investment schemes say when you receive the dividend you must pay the dividend. That's fine. In terms of Ireland, in terms of an Irish one, it will be fine because there's just no tax. The challenge would be in terms of the US listed one because there would be tax. Now, I honestly don't know the question. I'll dig it out and find. What I think is going to happen is because, so for example, when a collective investment scheme in South Africa, hedge fund, unit trust, or ETF, when they earn a dividend, they don't pay dividend tax. They then immediately pass it on to us, and they pay that dividend tax. That's why maybe they can't reinvest it. Maybe that's it, that they don't, because they're a corporate or a collective investment, and I don't know what the American phraseology is, they don't pay. Drop me a mail, I'll dig it out.
And then, again, if you're buying something that's domiciled in Ireland, but you're buying it through the London Stock Exchange, is there any risk of, for instance, with estate duty, where the Brits then say, well, that's
so technically it is, it's an asset in England. It's an technically it is an asset in the United Kingdom, my correction. Yes, so it would form part of that 325,000 sterling, which is the estate exempt. I mean, there must be, I don't know. I mean, that's your Dubai's and Belize and Virgin Islands, I don't know. Yeah, I'm not the expert there. My challenge, my wife might disagree, but when I'm dead, I got bigger problems than estate duty. I'm dead. There was a question over here. Palesa. For China ETFs, so there are two in our local market, one from Satrix, one from Signia. I slightly prefer the Signia one. And just so the question is thematics, what about China? I do like that type of thematic because it's actually quite big. It's not, you know, water or lithium or something. It's China. It's giant. So there are the two local listed ones. They are both on New York and on New York and FTSE, London, one being an Irish one. Typically when I'm looking for it to be an iShares, which is BlackRock, or I'm looking at for it to be the Vanguard, and they've both got China. Again, look at the nuances between it. You know, some of them are very much, some of them are investing into China via Hong Kong. I'm happy with that. Some of them have got A shares, which are China's listed. I'm also happy with that. But just check the nuances to it, because some of them, I saw one China, it was by a company I'd never heard of before. It was actually a China ETF, but what it was global companies that had presence in China. Now, I don't know what presence means. I mean, does that mean that like you sold a toothbrush and it counts, or is it 50% of you? They were vague about that, but there is a bunch. So.
There are two questions for you, Sami. Satrix Global. What's your opinions about?
No, I mean, it's global. I mean, truthfully, any global ETF I like. We've got nuances. But I like the fact that it's, you know, that it is just, it's bits of everything. So it'll have some South Korean company we've never heard of, some Japanese, etc., etc. I like the proper globals.
Offshore?
Yeah, you can deposit money from offshore. Yeah.
If you don't like to
Yeah, so you might not have ZAR. Yeah, you might have, I don't know, maybe you've got a stack of euros or dollars or whatever already offshore. You can fund it. You can fund your web trader with offshore money already. The difference is...
What's the negative?
There's no difference. I tell you what the phobia is, and I say this not because I believe it, but because I've been told it, that the government will come and take your assets. Frankly, I mean, you know, it depends what our relationship with America is. They might take our assets, but also the government might phone Trump and say we want those assets, and he might say yes. I mean, the short answer is your return is going to be the same. I mean, the global versus the VT, one's in rands, one's in dollars. It's the same shares. There is a slight cost difference. In that case, I think the cost difference is 0.15% per year. Total expense ratio is higher in South Africa than it is on the VT. Aside from that, it's the same thing.
the capital gains tax difference.
There is a CGT difference because you don't get the currency. Yeah, so you do get that uplift there. Yes, of course, that's the biggie.
So it's better if you offshore it.
Yeah.
But what is that difference exactly?
Well, 7% a year, because that's the rand weakness out. Yeah. Ma'am.
What's the best local platform to get exposure to gold? And is it possible to get a fraction of gold, or you've got to buy the full unit?
So you can get fractions of gold. So I think the best local platform, there are dozens of them. I've been using Shift for the last couple of years. I just like it. It's cheap, it's easy, it's slick. I smile at my phone and it unlocks, and I know I should get over that, but it works for me. If you want to buy gold, either on the JSE or on New York, the code is GLD. It is the same. And that gets you, in South Africa, it's 1/100th of an ounce. In New York, it's 1/10th of an ounce. And they both give you exposure to gold in dollar. So the simple question to what makes the simple question is high commodity prices. Commodity prices go through the roof. Every time that's happened for the last 50 years, our rand strengthens markedly. But that is short term and ultimately reverses. Yeah. Longer term, simple things like, let's say by the end of this year, we get off the grey listing, we get upgraded to investment grade. I mean, it's those sort of things. We pass a budget and stuff like that. We're much more stressed about the nuances of our country and our potholes and our water. Investors from the rest of the world are like, can I make a risk-adjusted return here? And if the answer is yes, they will invest into it. When Russia invaded Ukraine and they shut the Russian stock market, when they reopened that stock market, volumes went through the roof because folks were like, risk-adjusted return, we're into it. So in the immediate beyond our controls commodities, longer term, it's just simple stuff like, getting off the grey list, which could happen mid-year, becoming investment grade, which is going to take 4 to 5 years, but we could at least start moving in that right direction. I mean, if we think back to our golden period in the aughts under Manuel Mboweni and Mbeki, where we had GDP of plus 5%. Manuel was giving us tax cuts every year. Mboweni bought an inflation targeting and got inflation under control. We had come in as junk in '94. We became investment grade. If we had held on to that, then the currency, because you started it moves by the inflation differential. It doesn't, because there's other attributes to it. Folks, I know there are more questions. I'm going to park it. I will take your questions. Come chat to me afterwards, but I appreciate people who've got places to go and things to do, so I'll end it there. The video will be up in a couple of hours. We will be back on the 15th of May. Thank you very much to Standard Bank and Shift, and thank you all on the webcast for giving me an hour, and for the folks in Rosebank for, fighting traffic and potholes in Johannesburg. Thank you very much for your time.